So guys, Ace and I have talked about this a lot of times. Stop paying the IRS for your taxes. Start thinking about other ways and other strategies to go out and reinvest into yourself. What I mean by that is, instead of writing that check to $100,000 to the IRS, why not go ahead and invest in a short-term rental or commercial real estate property?
Yes.
Utilize a cost segregation, offset that taxable liability you owed, that $100,000, and now you keep that in your actual bank account. Now you go out and utilize a cost seg. Now you have another stream of income. So the following year, you now have two incomes. Maybe you purchase another type of short-term rental or another commercial real estate property. Utilize a cost seg, offset all of those taxable liabilities, and it's just a rinse and repeat. Before you know it, guys, you'll have a full portfolio of properties. You only paid off of your actual tax money that you're going to save. Utilize cost segregation to its fullest. You're not paying any taxes. You have multiple properties that are generating income, and you're living the dream, essentially.
What's going on, guys? This is your host, Ace Guzman of the MMM Podcast. And today, guys, I have an amazing guest for you guys, ready to give you guys some value on how you can utilize your real estate properties to its full advantages. I got Mr. Isaac Downing. He is the president of United Tax Advisors. Did I say that right, Isaac Downing?
Absolutely, you did. You did, Ace. Thank you so much.
Awesome. President of United Tax Advisors. And his firm specializes in cost segregation studies. Brother, can you explain to the people what a cost segregation is? Like a real quick
Absolutely, Ace. First of all, thank you so much for getting me on board today here. We're in for a treat. We're going to go over cost segregation and really understand what makes this special. We hear this a lot, and what are these specialty tax strategies allows these real estate investors and owners to really greatly offset their taxable liability. And that's what it's about, guys. And Ace, you understand more than anybody. We want to make sure to really take these tax deductions in order to not pay any taxes. That's the key, guys. We want to keep more money to ourselves and not go out and pay the IRS. That's going to be the key. The more money you keep, the richer you're going to be. So I'll give you a quick understanding of what cost segregation is. It is an amazing, powerful tax strategies that are utilized by real estate investors, by real estate, commercial, and residential real estate owners on this as well. Anyone with an investment property should be looking into this. So it can be done on a number of different properties. In fact, any property that's really generating income, you want to look at this strategy. Now, what this is something that's been around for quite a while, but with the recent changes in the tax legislation, it is better than it's ever been before, guys, and only getting better here in 2025. So what it works is it all relates off of depreciation. Depreciation is your main factor here that's going to be offsetting your taxable liability. And again, guys, the more money we're keeping within our pockets, the better we're going to be off to go out and invest in other opportunities. And that's what this really is. It's about the time value of money. Now, Ace, I don't have to tell you that, but you fully understand, a dollar a day isn't going to be worth the same as it is in the future. So let's keep majority of that funds immediately right now to utilize to go invest in other opportunities. So that's what cost segregation works. You have your standard deduction of this depreciation. You're going to be able to take within either 27 and a half years for residential real estate or 39 years for commercial real estate or short-term rental. Now, that's all fine and dandy. You get your basis amount and your divided amount, those specific amounts. That equates to about 1 to 2% throughout those 39 years. Now, 1 to 2% is a good tax savings, but a lot of these components in a building are not going to last 39 years. We're talking about flooring. We're talking about lighting. We're talking about that concrete outside of your perimeter of your house. All these specific items have a shorter asset live life than 39 years. I mean, I don't have to tell you that, Ace, but if you have anybody walking in your house or, going around your area, that flooring is not going to last, 39 years. So that's what the IRS has
Mm,
acknowledged, a 5-year asset life. So what you do in a cost segregation study is you're going out there and valuing out these specific components in your actual building or your residential home that you have for rental, and you go ahead and place them in this shorter asset live life. Instead of amortizing it over 39 years, you're now amortizing a portion over 5 or 15 years. That accelerates your depreciation, um, giving you a faster means to go ahead and accelerate that depreciation as an immediate tax offset. So it is an amazing strategy, and I'm just barely touching base on it. And there's a lot more details that go into it. But guys, if you're not utilizing it for your short-term or your commercial real estate or any type of long-term rental properties you have, I highly suggest looking into it.
you know what, man? It couldn't have been said better, by the way. And in simpler terms, man, like you really explained it right there, and really gave some um,
Mm.
insight on what it really, truly means for individuals who have these type of investments, have these type of, shall I say, real estate portfolios, right, where they can essentially utilize the cost seg to help them uh, essentially offset some taxable income. Now, I do want to ask, man, how long have you been
Yeah.
doing this for?
It's funny. I jumped into this world, after I was an engineer in the military. I was a combat engineer in the Marine Corps. Went to college and was and studied tax and accounting. And coincidentally, I got into this fixed asset world where I was segregating out assets, and this was 20 years ago. So, it was not a hot topic back then, really working with fixed assets and cost segregation. In fact, it's been around for quite a while, but not until recent changes here, the TCJA up in 2017 is when it really started kind of benefiting a lot of owners with, lower valued property. Now, this has been a tool that's been used for years. Back when I was doing this, I was the engineer doing the studies before I jumped into more of the managerial roles. We only saw properties over $1 million. Now, back then, $1 million was a lot of money, but now, Ace, where, if you're in California, $1 million property is just a small rental 2-bedroom house, essentially.
Oh
Uh,
man.
yeah, but what I'm getting at is the juice wasn't worth the squeeze. You had to do all this work to do a cost segregation study, and the benefit wasn't really there. Fast forward to 2017, the TCJA came out to play, 9/27/2017, and that's when it
Mm,
really started until 2022. We got 100% bonus depreciation. So
mm,
it immediately increased this amount of benefit for individuals that are looking to invest in short-term rentals like Airbnbs, and it allowed them to take, roughly around 20 to 30% of that basis amount. Now, basis is your purchase price minus your land allocation. So you want to kind of think about that. But what it is, imagine if you had $1 million property. Let's just say you bought a property for 1.2 million. Let's just say $200,000 of that was for land, so you exclude that. Now you're left with the $1 million basis. Imagine if you got yourself a 30% tax write-off you're able to take in year one, $300,000 out of that $1 million investment. That is a significant amount of tax savings. So, with that said, a lot of clients were like, well, Isaac, I don't need $300,000 of tax write-off, but that's fine. You go ahead and continue to keep carrying that forward until you utilize that full of that depreciation. So it's not something you lose. So guys, Ace and I have talked about this a lot of times, stop paying the IRS for your taxes. Start thinking about other ways and other strategies to go out and reinvest into yourself. What I mean by that is instead of writing that check to $100,000 to the IRS or whatever it is, why not go ahead and invest in a short-term rental or commercial real estate property,
yes.
utilize a cost segregation, offset that taxable liability you owed, that $100,000, and now you keep that in your actual bank account. Now you go out and utilize a cost seg. Now you have another stream of income. So the following year, you now have two incomes Maybe you purchase another type of short-term rental or another investment property, I'm sorry, commercial real estate property. Utilize a cost seg, offset all of those taxable liabilities, and it's just a rinse and repeat. Before you know it, guys, you'll have a full portfolio of properties. You only paid off of your actual tax money that you're going to save, and you now utilize cost segregation to its fullest. You're not paying any taxes. You have multiple properties that are generating income, and you're living the dream essentially.
I love it, man. I love it. And what I've realized, and I'll tell you, like, from what I've seen, people I've worked with, friends that I have, colleagues that I have, I hear it all the time, right? They got real estate, they have some type of property or some type of properties, and the majority of the time I hear that it's like long term that they're going for. It's like,
Yeah.
well, man, long term is awesome, right? And then I go, okay, well, what are you utilizing your property to its fullest tax benefit that it can give you? Some of them don't even know. I'll be honest. Some of them don't even know. A lot of people just get into real estate for cash flow, which is fine. I mean, that's cool and all. Yes, you want to have that consistency of some type of cash flow, right? And usually these individuals will have like a W-2 job, or business owners. Usually, though, from what I've heard so far from individuals, is usually W-2. I'll be honest, because my clients that do have real estate property that are business owners, they do use it right in a sense, but the ones where I do see a lot of the times where it's just for cash flow purposes, is individuals just wanting to have that other source of income, which again is perfectly fine. But if you're wanting to utilize again your real estate to its fullest benefit, utilize the cost seg, but long term is just one way. However, I know there's rule specifications, right? You have to make over 750 hours in order for you to essentially treat the income as a non-passive activity, because that's where you get the most benefits from. Now, if you have to treat it as a passive activity, obviously it does limit you on what you can do or what you can essentially deduct on your return, especially as a W-2 employee, right? Now, when these hours are being made, what I've also seen or what I've also heard, right? These individuals are putting in those hours, and a lot of people get it confused. Real estate professional status does not mean you need to be a real estate agent. No, like a lot of people think that, but no, it doesn't. It's not the same. It just means that you are essentially in the business of real estate, owning real
Yes.
estate, a real estate investor. Putting in hours, putting in your time. What 750 hours? What that's what 15 hours a
It's a
week.
lot. It's a lot, Ace. And you're right. You have to start really tracking this. And it's very important, you guys. You don't have to be essentially a real estate agent. Maybe you're a
Yeah,
developer. Maybe you're somebody that really focuses
exactly.
on the actual real estate. I myself, as somebody that is heavily focused on the cost segregation, we look at real estate all day. Something that some of our engineers also claim as well. So it depends on your involvement in actual real estate to really make that election as a real estate professional. Now, there's nuances to it, so I highly suggest everybody look into it. Now, what's the deal with real estate professional? I know we're kind of talking about it, but what does
Yeah,
that
go for
mean?
it. Go for it.
Yeah, so when we're talking about real estate professional, we're talking about pass through. That is going to be the key of this. And what is pass through? Well, pass through is going to be any type of deductions that you're getting on your commercial or your residential rental property and able to pass through, not only offsetting your taxable liability from your actual property, but also passing through and offsetting your W-2. Now, that is what everybody wants. Maybe you're a high net wealth individual that you're a doctor, you're a lawyer, maybe you're a computer analyst, or maybe you traded a lot of money and made a lot of money on cryptocurrency. Now, we want to make sure to offset any taxable liability because at the end of the day, guys, we're not trying to pay any taxes. We try and avoid that, whatever it is, and we are trying to invest in other opportunities. And that's what Ace and I are here to talk to you guys about. So when we're talking about this, yes, Ace, you're 100% right. In order to make that, you have to reach one of two options. One would be a real estate professional. The other would be to reach a certain area where we can now operate a business like a short-term rental property.
Yes.
So when we're
Tell them,
talking,
man. Tell them. What's
oh, I'm
that?
going to tell them, Ace,
Tell
it's
them.
coming. It is coming. And what we're talking about here, guys, is Ace told you a little bit about that 750 hours that you have to meet in order to meet the real estate professional. Now, guys, that is hard. It is not as easy as you think. Now, if you're dibbling dabbling with real estate, you may not be able to reach that. Or maybe you're a full-time employee with someplace else. And
Yes.
and you won't be able to reach that 750 hours. Now, there's another thing. A lot of people call it the short-term rental loophole. In a sense, it's not really a loophole, something that's been around for quite a while. But what we're looking at here is if you're managing essentially a business, if you're actually working as a short-term rental provider. Now that's going to be something you only have to reach over 150 hours, guys. So it's not something that you have to reach over 750, but what you have to do is you have to manage that property essentially yourself. So, you're going to have to reach over the 100 hours, that your average person cleans. Maybe they're cleaning company.
Yes.
Just reach over that. If you are
The
if you are
yeah.
managing your actual Airbnb rental, it now allows you to go ahead and offset if you're managing your W-2 rental, it now allows you to take that depreciation, not only offset that tax liability from your Airbnb, but also your W-2. So this is an amazing play for any high W-2
Mhm.
earners. Now, Ace, if you're paying, let's just say you made $100,000. If you made $100,000 a year, you're probably paying $30,000 at least in taxes.
Yeah.
Gone in your W-2, you're out there waiting for, your quote little refund that you may get. In actuality, you're just letting the IRS hold on to your money. Now, Ace, what if we were to go ahead and use that 30,000 that's already gone? Remember, it's already taken away. What happens if you took a little bit of money out of your savings, put a down payment on a short-term rental property? Maybe you bought yourself one of those nice little luxurious condos in
Mm.
Florida. You did a cost segregation. It's 2025. 100% bonus is coming into play. You now went and offsetted $50,000 here for utilizing a cost segregation. Maybe you bought yourself, I'm just going to use easy numbers here. We bought ourselves a property that's $100,000. You got a $30,000 tax write-off in year one. That is amazing. You bought that property in December of 2025. That means you only made one mortgage payment, but you now got a $30,000 tax write-off. It didn't generate any income, but what you did is you now offsetted your taxable liability from your W-2 and received a large refund. So now you're just sitting on the essential cash that you were supposed to pay the IRS. In fact, the IRS already took that cash. It's a refund check. So now you're sitting with essentially more money on hand. What do you think you're going to do, Ace? We're going to go buy more property.
I was about to say reinvest that.
Exactly.
That is the name of the game, man. That is the name of
Exactly.
the game. I know for the short term rental, the way I kind of explain it to clients when I show them the strategy, when I'm teaching them the strategy, I go, look, there's long term and then there's short term, and then I tell them a story. I go, look, the long term is this. I'm gonna tell you a story about a buddy of mine, right? He had recorded, and man, it was horrible. It was horrible. I felt for the guy, and he had recorded one of his long-term properties that he had, right? And he was like essentially just showing a video on Facebook. Dude, like they left the house a mess. It was like a pigsty, like hoarders. Like I was watching an episode of Hoarders. That was like it was bad. Like his tenant left it really bad. And I go, well, I guess that's a problem. Like if you're gonna get into long term now for short term, right? You got to each guest has to stay there at least 7 days or less. They got to be doing the 500 hours and then 100 hours more than the people that are working on their house, right? Or
Correct.
sorry, the cleaning up or whoever starts working for that business in a sense. Now, the reason why they want to qualify for that short-term rental loophole, or essentially, being able to utilize that short-term rental property to help offset taxable income. The reason why they want to track all those hours and essentially have all that to their paper trail is because first and foremost you just want to have that just in case there's an audit, and at the same time you want to show that you're treating what you're doing for your short term, that is being treated as a non-passive activity, because that's the trick, right? You got to that's business, right? Non-passive. Now the the way I kind of go, and going back to the story what I was talking about on the long-term rental, well, dude, your short-term rental is going to always be clean. And then you're going to get the property at a place that you travel to at least a couple times out of the year, once or maybe more than a couple times out of the year. If you want to go get a place to where you vacation at, by all means, look at getting a short-term rental property there. Look at getting a property there, so that way when you decide to go out and vacation, when you decide to go out and travel, you already got a place there for you. Now that travel even becomes a business deduction. You're going to go check up on the rental. You're going to have a place to stay. It's going to be clean. It's going to be ready for you. I got a colleague of mine who is another tax strategist, and as a matter of fact, I just had him on the episode, on the podcast for an episode, and he talked about how he has a property up there in Oklahoma, and they kind of like pass by every time he goes up and down from Tennessee. And actually, I need to check on how his hunting trip went, but he he said that the one time that he had stayed a night there, he couldn't believe that he had owned the place because it was just so nice, right? And it's like, yeah, like, that's one of the good things about short term. But if
Yeah.
short term is going to be utilized, obviously, we want to make sure that the client has all the paper trail, all the proper documentation, so that way they're able to utilize um, their property to its full extent on treating it for tax strategy purposes, on utilizing the cost seg. Now, I know you were talking about um, the cost seg and the components to that, and
Yeah.
I was looking at the forms that you had sent too, and I'm just like, man, like that can be depreciated. That can be,
Yeah.
like there was like the electrical wiring. I think I saw the flooring,
Oh, yeah.
the walls, and cabinets, and I'm like, dude, what? Like,
Yeah, it is cool, Ace. And we're just barely scratching the surface, guys. When it comes to cost segregation, there is so much opportunity here for clients that it's painful when people are not looking into this and going out and paying money to the IRS. Again, guys, this is the strategy that's utilized to stop paying the IRS for your taxes. Why not go back and reinvest in yourself? Purchase that short-term or long-term rental like Ace was talking about. And like when you're talking about these components that are able to go ahead and value and go ahead and accelerate the depreciation, there's so many components.
mhm,
Just in a short-term rental property we just looked at here. In fact, I was looking at it right before this call. I
mm.
was looking at things like swimming pools in your backyard. Those are big ticket items. All that whole entire land improvements outside.
Swimming pools as well, huh?
Oh, those
Man,
are big items. People don't
oh,
think about that. They're expensive. And how do you value out a swimming pool when you just bought a property? Well, guys, you got to use a tool called Marshall Value and Swift, and that is an engineer pricing guide. And that's how we're going ahead and measuring those out. So when you're going out there and saying, how does this cost segregation work? Well, you got an accredited engineer that's going out there and measuring out the specifics of a pool, whether it's doing it virtually from an actual site, or he's going in person and he's measuring out this pool. When he does that, he goes and looks up the actual pricing through an engineering price guide, as well gets your location factor. Because Ace, I can tell you right now, installing a pool in Southern California is probably a lot more expensive than it is in installing it in Oklahoma. So these specifics really make into play when you're talking about pool construction on there. So when you're valuing out these components, you're talking about your pool, you're talking about special piping as well and specialty plumbing that it comes to it. So there's all these components. Now let's take, for instance, lighting or one of these fans or your actual fans that you have in your house, your rental property. Not just your fans you're going to be able to take, you're also going to be able to take your electrical components, your conduit on this as well, that you're able to take the whole entire housing of that lighting fixture you're able to take. So, when we're looking at it, it's from a full engineering standpoint where you're taking the entire assembly kit, and that's how you're going in and value these out. So, you don't want to just think about, oh, well, it's only a little bit of deductions, or it's only one duplex. Duplex is a plug in terms. So when you're looking at it, you're walking through the entire property. You're looking at, your outlets. You're looking at your window treatments. You're looking at your actual flooring, your plumbing, your sinks, all these little components in a building. And that's what adds up. 30% sometimes, in fact, We recently did a property that received upwards over 40 and 50%. So guys, imagine if you had a property and it was a 50% tax write-off. That is crazy. You know,
Man, I love that.
you're
Hey,
not going to get taxes
do you
for
think it's gonna
years.
go back up?
Oh, it is. It is.
Oh,
So guys, what we're talking about here is a thing called bonus depreciation.
oh,
Now this is it for everybody, man. We can talk hours about this, but what happened was, remember that date that we talked about, that 9/27/2017? Well, that was the start of the TCJA. Now, when the TCJA came out, people were like, well, yes, the bonus depreciation is up to 100%. And they were like, well, okay, well, this is great for our commercial real estate. People were not thinking about residential rental properties. However, around 2019, people started thinking about this and it really started to take off up into 2020 to 2022. However, 2022 came and they were like, okay, the TCJA it's going to be phasing out now. The Democratic Party was like trying to push out the TCJA and it's ramping down. So it went in 2022. So that means if you bought a property from 17 to 2022, you get a 100% bonus. You can still utilize this to this day. It's about when you purchased the property. 2022 came around, everyone was jumping for joy. They're buying their short-term investment properties, getting huge amount of benefits. It started going down. What I mean by that is the bonus depreciation. You didn't get all of that in year one. Some of it has to be amortized into 5 or 15 years. As it started going down, people are still investing because there's still an amazing amount. So if you bought a property in 2024, it went from 2022 at 100%, 2023 to 80%, 2024 at 60%. Now, you still get the full amount of benefit. What I mean by 60% is you only get 60% upfront in year one. The remaining balance gets amortized over 5 and 15 years. Come to where we're at now, Ace, 2025. The Republican Party is back in office. President Trump, the person who went and established the TCJA, is now back in it. And then now it is talked all across the CPA boards, all across the internet. The TCJA will be returning. It hasn't been 100% official yet, but you can go ahead and hear it here first. It is coming back. That means 100% bonus depreciation, guys. So
mm,
if you guys have been sleeping on that investment property, waiting for the right opportunity, this may be it. At 100%, you better believe I'm going out there and buying some investment properties because I am not writing a check to the IRS. I'm going out there
mm,
and reinvesting it into myself, guys.
mm.
So, reach out to Ace here. I know that we can go ahead and help you out here. We're happy to help you out with any cost segregation studies. Start thinking about this. Maybe you run it by Ace and I go, hey, I got a couple properties I was thinking about buying, but let me see exactly how much percentage I can get back in the first year with the cost seg because all properties are not the same. Ace, we were talking about these type of properties. We're like, okay, well, what about it has a pool? How much percent I can get? Well, I'll tell you right now, if you bought an investment property with the pool, that's going to be significantly amount more. It's going to be significant amount. Maybe you bought a property in Florida that's one of those high-rise townhouses, you got to think about, or those condos. A lot of them have high-end fixtures and finishes. So let's take a look at all that. Um,
Yes,
so it's very important when you're looking at properties to start thinking about this. Don't only think about cash flow. Cash flow is great, guys. Cash is king, as we know.
yes, yes,
But start thinking about things like taxes, because at the end of the day, you're going to have to pay Uncle Sam. So you better find a way to offset.
exactly, exactly, and that's exactly the mindset people need to shift from. It's not only with real estate, especially the first year that you get it. It's not only about the cash flow you want to build up, it's about the offset that it can do to your taxes.
Right,
Utilize
exactly.
to its fullest potential that you possibly can. Now,
Yeah.
I know the
Yeah. Well, I could give you,
I hate it when this happens.
let me tell you about this,
Yeah,
Ace.
go
Let me
for
give
it.
you a quick case study that we just recently worked on. We had an individual that purchased themselves a mobile home park, guys. Now, remember, we're talking about all those fixtures. We're talking about light.
Yeah,
We're talking
man.
about
You
all
know what
that.
I heard about mobile home parks that like the RV parks?
Oh, yeah. These
Yes.
are big ticket items, guys. We're not talking about 10, 20, 30% accelerated depreciation. We're talking more along the lines of 60, 70, 80,
Mm.
90% tax write-off when we're talking about these mobile home guys.
How does that work, man? Can you
Oh,
speak?
it is amazing. Well, think about this. When you buy yourself a mobile home park, what do you have? Well, We have mobile home parks. We have mobile homes, obviously. Are they owned by the tenant? No, they're not. I'm sorry, by the owner? No, they're owned by the individuals that are renting out their spots. So when you have a mobile home park, all you really have is, concrete slabs and some electrical and plumbing specialty items on this as well. Well, those concrete slabs, those are 15-year items and they're bonus eligible. So what you really have is just some concrete pads. You have a percentage you're able to allocate to land, but the actual spot that's dedicated to building, a lot of times these don't have an actual building. They have things that are fully depreciable under the eyes of the IRS. So it is a huge amount of benefit for them because we're not having to allocate a certain percentage to structure essentially the entire property's special purpose. So now you can go ahead and offset that 60, 70, 80% in year one with bonus depreciation, guys.
Mm,
Look into that. Don't
mm.
look at it like, well, maybe they're not generating a type of income, because you got to remember, yes, cash flow is one thing, but saving and not having it pay out, like you can have the best cash flow on earth, but if you're paying all of it back to the IRS, how much are you really keeping? So maybe
Yes.
we might want to think about
Yep.
looking at an opportunity with maybe a little bit less cash flow, but bigger tax offset. Now collecting more to keep inside yourself and now to keep more in your bank account and go out and utilize that money to go out and invest in other opportunities.
Yes, man, there you go. Because that's what I was going to talk about, the going back and investing. Because I know um, people do have that question, and they go, "Well, yeah, I'm going to get these losses, but how am I going to show the bank I made money?" Well, see, that's the good part, because the bank adds all that depreciation back, and all that depreciation that gets added back, that's essentially money they could borrow against, or essentially what you can utilize against as collateral, right? That's what it is. Whenever you're
Absolutely.
borrowing money from the bank, they want to see all that, because I mean you already have a list of assets. Essentially, your list of depreciation gets all added back, and they're like, okay, well, we see that you have all this money in assets. And correct me if I'm wrong. I don't know if that's the way.
Yeah, no, you're right.
Yeah.
You're talking about on the loan purchase. You're talking about your
Yes.
purchasing power here. And
Yes.
you're right. So a lot of people think, well, if I depreciate, is my value of my property? No, it's not. It's not looked at when you're looking at the loan purposes side. And that's a different area when we're talking about the tax side. But in short,
Yes.
you're 100% right, Ace. It's something when you're looking at it, because people are thinking, well, hey, Isaac, if I just depreciated 50% of my investment property, is it worth now 50% less? No, guys, it's still worth it. You could still go out and sell it for that same exact price or essentially more, because I'm hoping that it's appreciating in value. It's not going to decrease the actual sellable value on it. What it is depreciating the taxable value that we're looking at here for IRS
Mm,
purposes. So again,
mm,
guys, this is a play to avoid any type of federal income taxes that you're going to be paying on that property. Because the way you want to think about it, guys, and I try to simplify it as much as possible, the IRS is sitting there looking at you and they're waiting. You're making money, they want their cut as well. You're doing
yeah.
something else, they want a cut. Hey, you found
Yes.
you found out you got a refund. Hey, they want a cut of that too. So they're always trying to figure out ways to do it. Now, when you're getting such a huge amount of benefit like this, we're talking, 20, 30, 40, 50, 60% sometimes of that basis amount. And you go, okay, IRS, thank you. I'm not paying any money on taxes for a little bit of while, because I have multiple years you can carry forward. You know what the IRS says, if you decide the following year to sell the property, the IRS is going to be like, hold up. Now it's not, we talked about the benefits of it, but is there ever a bad time to do it? Well, in actuality, you may want to hold off if you're a flipper. The reason why is a thing called depreciation recapture. Now, the IRS, like we talked about before, you're getting a huge tax break. But if you say, hey, IRS, I'm not paying taxes this year, but next year I'm selling the houses and I'm not paying you as well because I have a huge amount of offset,
Mm,
they're going to be like, hold up, Isaac, you're going to have to pay a little bit something. That's called depreciation capture, which up to about 25% of that. So some investors do realize that, hey, well, my ordinary income rate is a lot higher than 25%. So I don't care. And there is opportunity because you're right. What if they're at a 35% income tax bracket, but they're only paying back 25%? So one year they got a huge amount of benefit. They paid depreciation recapture at 25%. Maybe their delta's a little bit different. But what I'm getting at here, guys, is, we want to hold on to the property when you're doing a cost segregation for at least 3 years. But if not, there's ways to offset it, and you can offset that depreciation and recapture via a 1031 exchange.
Yeah, I was about to bring that up, man. You're reading my mind.
Oh, we're reading them.
There you
We're
go. I
aligned here,
love it. I
Abe.
love it. I love it. Tell the
We're
people, man. Tell the people what's a 1031 exchange, man.
Yeah, so a 1031 exchange is an amazing tool, guys. So if you have a property and you're going out there and buying yourself, you're going and investing in these commercial properties, these commercial rental properties as well. I'm sorry, residential or commercial rental properties, and you're going ahead and selling it and you're getting hit with the gain. There's a method that's called a 1031 exchange that you can roll over that gain and place it into another investment property on this as well. And this way,
Yes,
defer any type of actual taxable liability you're going to owe to the IRS via a
dude.
1031 exchange. Now, get this, guys. If there's a step up in basis, you can now do a 1031 exchange in conjunction with the cost segregation. So, guys, what I'm getting at here, there is a lot of tax breaks that are open to all of us.
Yes.
We just have to explore them, have to ask a
The
professional.
code is written for
It
you not
is.
to pay any taxes, man. The code is written in a way, it is a game plan. It is A to B way of essentially going from here to here. It's like, okay, yes, we could charge you taxes, but we're also going to show you how to not pay taxes, but you got to do your due diligence, right? And that's where essentially what you're talking about. And I'm sorry, man, don't mean to cut you off,
No.
but I was actually just talking about 1031 exchange with a client the other day because he's wanting to sell off a property. Right now, we're trying to see what we can do to do that because he wants to get that property sold off, and then that money that he makes. I know they have only like a certain time frame to essentially get the money and then move it somewhere else that essentially they don't have to get taxed right on that
Right.
money that they're essentially reinvesting to another property. Now, I don't know the time frame on top of my head, but essentially you can't hold on to the cash for too long, right? Because
Yes.
you be
Yes.
moving.
There's a lot of nuances when it comes to 1031 exchanges. And when I really try to jump into it, what we do at our firm here is we really work in conjunction with that 1031 exchange via the cost segregation study. Now, again, any type of times you're talking about these type of moves, there's going to be essentially a time frame. And when you're talking about when you sell a property and you're going to go out and you think about it, you're going to sell a property. You're pretty much at the time of you're going to sell your property. At that point, you should understand, hey, if I'm going to be receiving a gain or not. You would personally know. Hopefully you would. Hopefully you'd have some type of insight of your property to see, hey, where are we at here? Now, if you're going to make a gain on there for a property, you want to think about that ahead of time because you want to strategize. You want to think about your possible opportunities, how I'm going to mitigate that specific gain. And a 1031 exchange is a powerful tool for that because you're going to be
Yes.
rolling it over. But you're right, there is a time frame that you're able to do that. You have to go out and reinvest in another opportunity.
Yes.
What happens if there's no opportunity then? What happens if you can't find a property within that 90-day time frame that you're
There
looking at?
you go. Yes.
You have to really start preparing. So, guys,
That
start
yeah,
look, start
that
doing things. It never hurts if you're thinking about potentially selling the property to start also thinking about your taxable liability and really
exactly.
find ways to mitigate that, man, because like at the end of the day, like we're talked about, cash flow is king and that always going to be, but keeping more money in your pocket is going to be the real game because the last thing we want to do again is pay the IRS. So let's just figure out ways to really utilize that in a real manner, like utilizing these tools. And you tapped on it, Ace. You said it exactly. You're like, hey, the code is out there, guys. This IRS rules, and we're not writing and we're not doing any type of gray area or any type of things like that. No, these are all legitimate tools. One of the questions that people always ask is, hey, is this something that's gonna, pop a red flag and the IRS says, hey, come audit me? No. Cost segregation is the preferred method, guys. It is what they're actually asking you to do. and you have an actual engineer that are doing these studies that are breaking down these specific components. So if by chance, if anything ever comes arises, we have a fully documented report that states each specific component that can order in order to qualify and make that IRS standpoint of not paying those taxes. So whether that is a 1031 exchange, whether it's a cost segregation, whether you're looking at 179 expensing or any type of other types of rules, we always suggest you to go talk to a professional and talk to them.
Yes.
Hopefully, they don't charge you any money in initial consulting, but in short, it is extremely beneficial to start exploring these options and start thinking about them before the end of the year, guys. Don't come to us at you know December 31st and say, "Hey, it's time to
Yeah.
start thinking about my strategy for this year."
Yeah,
No.
I've seen I've seen that basically the time frame that other tax strategists have, and I also follow that rule of thumb. By December 1st of whatever the year is, that's the deadline because it takes time essentially, right? So people want obviously think about taxes usually towards tax season, which is the wrong time to think about taxes because you should be thinking about taxes like right now should be the time to be thinking about 2025 taxes. Yes, people, it's still tax season. People are thinking 2024, but you need to plan for 2025. Now that's exactly where I was going to get at as well too, because you were talking about, well, yeah, you're going to do the 1031 exchange. Yeah, you got to wait the 90-day time frame period, but you already have to know where that money's going to go, so that way you're not holding on to that money for that 90-day period or prolonging that, essentially, and then getting taxed. Right? That's why it's crucial to work with the tax strategists. That's
Mhm.
why it's crucial to have somebody on your team like you and I to essentially make sure that all those movements are happening at the right time and everything's being planned ahead. That's what tax planning is.
Yeah.
That's exactly what it is. That's what tax planning is. It's essentially planning out how the year is going to look, planning out the projections, and then inputting the strategies on each a certain time frame, each basically just road mapping that. It's like, okay, well, this month we could do this month we could do that, but you know what, right here this is where we're going to make the move, and then right here we're going to make this other move. And it's essentially just planning it out and knowing where we can hit. And it's
Yeah.
essential that your tax strategist, I'm not going to say tax preparer because it's two different things. Tax preparations, compliance, tax strategy, however, is all year round. It's crucial that your tax strategist is doing what's called a mock return. I call them mock returns. People call them dummy returns. You could call them basically, draft returns or whatever the case may be, because you want to make sure that it's being tracked all year round. And I noticed that in order to show success to your clients, you want to show them the strategies and you want to be able to explain the strategies. And like you were saying, talk to a professional man. All they got to do is just watch his video. All they got to do is
Yeah.
watch his video. So much value was given.
Uh, there
So
is,
much value was given, and they could, man,
yeah,
they could take what they want from this video and run with it. I'm telling you. And the beauty, though, the beauty of it is that there's ways to go from here to there on your taxes and keeping and retaining that money in your pocket. So that way you're showing some type of ROI for the money that you are essentially investing
exactly.
instead of giving it to the IRS. Because if you give it to the IRS, you're not going to have anything to show for it. And then they're putting the money on stupid shit anyways.
Yeah.
So might as well build your wealth and reduce your taxes at the same time.
Exactly. It's like, are you gonna let somebody hold on to your money, forever
Yeah.
and then just collect a little bit of benefit? By all means, man, we're talking about the time value of money here, especially when you're looking at the benefit. You have your property, your investment property is gonna last you, 39 years. I don't want to be a downer, Ace, but in 39 years, I don't know if I'll be alive. But I
Um,
also don't know if that money that I'm going to be able to take, that depreciation is going to be even there, or how much is that $1,000 or that $10,000 I'm taking in depreciation every year is going to be even worth in 39 years. I mean, I told you that story where my boy went out to McDonald's and bought himself a Big Mac meal. It was $18. Now,
Oof.
back what, 10 years ago or so, or like when I was a young kid 20, 30 years ago, when I was buying a Big Mac meal, I was lucky if it reached $5. It's just inflated so much. It
It is
costs
it is bad.
But
It's bad. Yeah,
that
inflation is horrible.
depreciation value, unfortunately, is not rising to the standards of the actual economy. It's just stagnant, staying at that same exact straight line way. So, in a sense, that depreciation is going down, even though you're getting a benefit because of the economy is rising on there through inflation. So, like we talked about here, guys, if you're going to go out there and if you're making any money, it's important to do your tax strategy, do those dummy returns, start looking into it and start thinking about it maybe halfway through the year, throughout the year of, hey, look, I'm potentially going to make this amount of money. I'm going to pay the IRS X amount of dollars via my W-2 or via my actual company or my investment portfolio. We want to start thinking, what could I potentially do to mitigate that taxable liability, whether it's reinvesting in other opportunities or looking at other types of strategies. Cost segregation is my personal favorite. In fact, that's why we specialize in it. And it's something that we've been around and we are confident in that I assure you that it's something that every single person, with the high W-2 or just that individual that looking to get into real estate and really start looking at there's other opportunities, or even that person that never thought about getting into real estate because maybe they just didn't have the cash. When in actuality, they may have had the cash that's there. So there's other ways to really look at it, whether
They
it's your
may have had the cash, but they were just giving it to the IRS.
exactly,
I'll tell you that much. I'll tell you that much. And I see it. I see it with people. I hear the story all the time and time again. Hey, man, I'm tired of working for the IRS. I feel like I'm just running my business to just give them a check, and that's not how it has to be. I
yeah.
I do have a client, and we're kind of already cutting it with some time here, but I'll
Hmm.
tell you, I got a client of mine that had utilized his IUL,
Hmm.
borrowed against it, and that money he borrowed against, he put it into real estate. And so that's also another way to go at it. So that way, essentially, you're yeah, you got to pay that money back, but you're paying it back to yourself. You're not giving it to the bank.
Yeah.
And man, but there's so many components though when it comes down into structuring it in a certain way. So that way, it's just first and foremost, you're implementing to its fullest potential on the cost seg side, on the tax strategy side, and then aside from there, managing that, right? Because people want to be able to keep an eye on those numbers. And I honestly will say, once those properties start coming in, manage those numbers, put those numbers, have a separate account for that, because you want to see what's coming in and then you want to see what's going out. Essentially, not only is it a big component to taxes for tax preparation, see, that's where the tax preparation, the compliancy comes into play, because you
Hmm.
want to make sure you have your books in order. And yeah, that's then required for you to get some bookkeeping, but they can do their own bookkeeping, and that can be hours that they can get. But
Yeah, absolutely.
yeah,
Keep your books, guys. Keep
yes,
track of it. It's oftentimes you see like, hey, look, like we're talking about, if you're not keeping track of that accountability of your expenses that you're out there spending, it's only going to benefit you. Yes, I get it. I hear it from a lot of clients. Well, I don't have any receipts or I don't have any type of tracking or I don't have any type of stuff. Well, let's start doing that, guys. Let's take a little bit of extra step. There's all these new apps online. There's all these new trackers. Keep in line a little ledger on Excel that can help you out. Look online.
yes.
There's so much tools out there that people are just not utilizing. Because again, like you talked about, Ace, if you're keeping a track of, you have a good accountability of your expenses, of your spending that you're doing for these investment or commercial real estate properties, it's going to come back to you tenfold via tax write-off.
I love it. Well, Isaac, how can these people find you, man? How can my
Yeah,
followers, how can my subscribers, how can they find you, man?
yeah.
Where can they
So
find you on
a
social media?
number of different ways here. First of all, you can come reach out to Ace as well. Ace always has connections here with the cost segregation studies, or you can just go out to unitedtaxadvisors.com. We're online. We're here, cost segregation supporters here. So any type of questions, any type of needs, feel free to give me a call directly if you want on this as well. I'll provide our contact information after this video here, and you feel free to reach out. Any type of questions, no dumb questions. We'll gladly answer them. And sometimes maybe you do have a rental property. Maybe you're not even thinking about doing this type of stuff, but I would highly suggest looking into it. At least getting estimates are always free of charge, guys. And even if you're thinking about purchasing a property here within this year, why don't we get a free estimate on that too?
Mm,
Because, like we talked about, certain properties yield bigger tax benefits. So, just go out there and ask. It's always free of charge, these type of questions and these type of services. The only time it really does charge is when you do an actual full cost seg study. So, reach out, talk to your tax strategist, talk to your cost segregation expert, talk to ACE for all your different types of real estate needs. We're always here to help you out.
I love it, man. Well, thank you so much for taking time out of your busy schedule. I appreciate you coming on. And guys, thank you guys for tuning in on this episode. Um, that's really just about it. Get your mind right, get your people right, and get your money right, baby. Let's go.